Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, on November 15th, 2022. It's great having you with me here today. And today we got some good numbers on the economy. First, let's talk about November. Yes, we're starting to get the first readings to how November is looking. We get this through the Fed surveys. The Empire from the New York City area is the first one that kicks off. What did we see? We actually saw a positive number. We saw it rising almost 5, expectations for a drop of 6. But deep in the details, we see employment. We see work weeks. We see number of employees going up. Not exactly the sign you would expect if the fear of a recession was imminent. We also saw on the side of thinking about the recession, we saw new orders dropping and we saw inventories rising. So those were consistent. The employment picture was not. And remember, we're going to have this dual fight between employment, which is staying strong, and the worries about inflation stemmed on by the higher interest rates. And it really had its battle inside the Empire reading last for this month. On the ZEW, this is the German look at November. What are we seeing there? We see a modest uptick. Yes, clearly negative, but less negative. And what drove the less negative? We see improvements with the financial sector. Higher rates are helping. They're helping the financial sector, which has struggled with low interest rates over a period of time. Automobiles still weak, construction very weak. So clearly not out of the woods, but a little bit of improvement. So as November has moved along, we have seen a better sign of the economy. Now looking at our second reading that we get in the month for inflation, this is probably the least favorite and probably the less meaningful of the group because it looks a little bit more forward. What do we see there? We see the producer price index. It came in at half the expectations, 0.2 versus 0.4. But most importantly, on the core number, we saw that coming in flat. Yes, we had a little bit of fuel elements, but we had some trade-offs with food. So that's a helpful sign. But in the numbers particularly, and in the core numbers, we saw a decrease in prices for services. And that's been the wild card, right? We've seen the backing off of non-durables. And then we're slowly seeing the back off of durables. Those are autos and things more than 3 years. Yet services continue to be going up. We had seen that with housing. We saw that with medical, 2 major important components of services. Now that we're seeing weakness in the most forward-looking data, that gives us some sense that the market is looking at lower interest rates. When we see expectations about TIPS, these are Treasury protected securities, over the next couple of months, we see those expectations of the maturity prints for CPI for those bonds coming in lower. That's actually another confirming element. And we do not want to dismiss overnight Real Clear Politics and other agencies like the Associated Press put the Republicans 1 seat away from claiming a majority at 217. Yes, the election was a week ago. Counting has been going on. So expectations, they're still leading in 4 races that are out there, 3 in California and 1 in Colorado. And so the majority may be a little higher than 219, 220. However, that seems to be where if 1 or 2 of these races that are very tight move the other way. But yes, split government does seem to be a reality with this overhang of some type of possibility that through loss of members or other changes that they may not be a continuous majority through the term, but it's going to start out as at least a solid enough that it can be a workable one split government is rewarded by the market. It sees that as a way of averting spending and taxes or adjustments that are not expected. So a constructive sign for the market there today also. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.